What's up, guys? As you can tell by the title, we're doing a bit of study. Let me get the hat on. Alright, now, what we are studying is fundamental side of trading. And seeing how, where, and when to incorporate that into my technical analysis. I just made a dope pasta. I couldn't even tell you what the recipe is. I forgot what I put in it. I just made it from scratch. That shit is bussin'. Oh my god, that was the first bite. That shit is bussin', bro. Oh my god, bro. Holy fuck. Tomatoes from my backyard and all. Mate. Let's get right into the study. Okay, look, I don't know where to start with this, but like everyone, we're gonna start with YouTube, and we're gonna get distracted immediately.
Come up here and play the orbs for this intro. This person also came up on stage and played, or you played like Shelter on the little MIDI pad last time in Australia, right? Get on up here, it's your chance. I never do this. I brought somebody up here to play these one time because the shit like broke and I had to find a reason to fill the silence. But this dude has been begging show after show after show. It's time. Also, a lot of people think this instrument is fake because there's like a little light delay. It's not fucking fake. Last time I'm addressing it. This shit is real, okay? All right, get on up here. Where's he at?
Sorry guys.
I don't even know who these people are.
Remind me of your name one more time.
Luke.
Okay, everybody give it up for Luke one time. One thing I do want to warn you about is I've like shattered these on stage before. You got to be super careful. I've like broken multiple, and we have to go to the Japan show right after this, and these are the last ones we have. Please don't break my balls, Luke.
What is this, man? I don't know, like, oh my god. Fundamental Analysis Simplified, the ultimate guide for traders.
All right, you guys, we've been asking for it. It's time to get into some fundamental analysis. In today's video, we're going to do a sort of beginner / introduction to fundamental analysis for people out there who want to incorporate it in their own trading. It is A key component to my trading strategy is, using fundamentals to help guide my directional bias in various markets in the currencies, as well as even in the stock market and other places as well. But today I'm going to give you guys sort of an introduction. I know on YouTube it is very popular to talk about the technical side, and I think I have some pretty good videos on those subjects, things like moving averages and Fibonacci retracements and support and resistance. I find that stuff valuable, but today I think we need to dive in a little bit on the fundamental side. So before we get going, do me a favor and just like the video down below if you like my content, and subscribe to the channel if you're new so that you can watch more of it in the future. Okay, let's get into it. So fundamentals, why they matter. Well, fundamentals, there's some mixed opinions here. The reason a lot of people don't talk about fundamentals is because, quite honestly, they are a little bit more difficult in my view than technical analysis. We all kind of understand the concept of supply and demand, or looking for levels on a chart where things could reverse or continue. That sort of makes sense to a lot of people. But fundamentals, truth be told, they are still something that I am continuing to improve on and learn. Like, I've been doing this for a while, and there's a lot to this stuff. It is not a simple thing. There's a reason why people go to college for economics and they look at this stuff in depth. And most of the people that work in major institutions, or even the central banks, they have PhDs in this stuff, if not multiple, and they take it very, very seriously. So why should the average person care? Well, some people say you don't need it. Others say, you do need it. I think that it really helps me because I personally like to understand why, at a basic level, am I buying the US dollar or buying the euro or buying the yen? Why am I buying it, or why am I selling a currency? Understanding the economies that we are working with and sort of trying to get an idea of whether or not a economy itself is healthy or sort of diminishing can be a huge help in guiding my currency trades. Fundamentals are truly what drives a market's value, right? If an economy is doing well, their currency could reflect that. If an economy is doing poorly, it could also be impacting their currency as well. Fundamental trends, they can last from minutes to years. So if you get a news release, obviously that can have a lot of impact in the short term, but in terms of long term, there also can be some major impacts from economic data and all the stuff that we're about to get to in this video. For me, fundamentals help me pick a direction, while technicals help me pick entries and exits. I'll say that again because it's kind of important. So I use fundamentals to help me pick direction. One of the biggest criticisms that people have for fundamentals is that it doesn't really help you so much with timing, because fundamentals can be quite, they can last from minutes to years. So their impact can be you could be bullish on a currency, and that currency could go down for quite a while before it actually ends up going your direction that you had a bias on. So fundamentals for picking a direction, whereas I use technicals to sort of look for entries and exits, if that makes sense. So technicals are sort of my in and outs, and then fundamentals help me actually pick the direction that I want to trade in. Okay, so there's three pillars. There's three main pillars that we are going to cover in this video for this sort of introductory level. Now, please note, we could spend hours and hours on each one of these things. There's a lot to this stuff, and I would be not telling the full truth if I didn't tell you that, there's a lot of stuff here. This is not something that is easy and we're going to be able to get through in just a few minutes or anything like that. This is going to give you a surface level understanding of these concepts so that you can go take more time to go read more in depth and look more in depth into this stuff. There's reasons why there's entire companies around producing this content. In fact, my company, A1 Trading, we are trying to do our very best to sort of put out content that helps people decipher all of the information that is flowing around this stuff. So let's try and dive into these main three pillars. The three pillars that I have listed here are going to be economic data. These are things like unemployment rates, GDP, interest rates, etc. And then central bank decisions, which are things like the Federal Reserve in the United States or the ECB in Europe or wherever, right? and they have monetary agendas or policies that they can put in place to try and strengthen or weaken, in some cases, their own currency, which sounds weird, but sometimes you might actually, some central banks might actually elect to weaken their currency on purpose. So we'll talk a little bit about that as we get along. Again, just buckle up, stay tuned, and let's keep going. So the last one is going to be geopolitical events. Now, we probably all know about these, whether or not.
Ow. Just gonna go grab a drink, guys. I'm gonna bed. You wanna go on my bed? You go up there? Mwah. Oh, that big stretch. Okay. Are you ready? Alright, guys. Pina colada sparkling drink.
We incorporate them in our trading. It is something that we all are impacted by, especially if you are in a region where something like this is occurring, something like some sort of war, or we are all facing at the time of making this video a global pandemic. And then you have things like, for example, Brexit. These are regional things that can happen, and they can impact economies and they can impact currencies. Okay. So those are the three pillars. Let's dive into each one individually. So the first one is going to probably be our longest one. This is going to be our economic data. So these are measurements and data points that people, keep an eye on in terms of trading. The first one is going to be interest rates. Now, an interest rate, to sum it up, or I got this definition off of Wikipedia, I believe. An interest rate is the amount of interest due per period as a proportion of the amount lent, deposited, or borrowed. The total interest on an amount lent or borrowed depends on the principal sum, the interest rate, the compounding frequency, and the length of time over which it is lent, deposited, or borrowed. That was a lot. But the idea basically is that higher interest rates in an economy or by a central bank are viewed as hawkish or good for a currency, making it more valuable, right? If a bank is offering you more interest.
Let me just get something out of the way. Okay. I need to get my notepad. One second, bro. Fuck, where did I put it? Fact, it's not in there. I'll just use this one. Alright, so let's have a look at what we're learning. Okay. This one will be in relation to dollars versus index. Why a stronger dollar is bad for indexes. International exposure. I'm going to start off with this. Many US companies in major indexes like the S&P 500 earn a significant portion of their revenue from overseas. A stronger US dollar makes US goods and services more expensive for foreign buyers, potentially reducing demand for those products and negatively impacting the profits of these companies. Okay. Okay. Higher borrowing costs. As mentioned before, a stronger dollar can signal higher interest rates, which can make borrowing more expensive for businesses. This, in turn, can lead to lower corporate profits and slower growth, which might negatively impact stock indexes. Okay. I can just write higher interest rates make it more expensive for companies to borrow money which can slow down growth and affect profits. Okay, capital flows. A stronger dollar can attract foreign capital into the US. Can affect foreign capital. Attract. Okay. A stronger dollar can attract foreign capital into the US for safe haven reasons, especially during times of economic uncertainty and geopolitical tension. I sound like Jaden Smith. This could pull capital out of emerging markets and other regions, which could hurt global economic growth and indirectly affect the US stock market. Right, okay. Now let's go into why a stronger dollar might not always be bad. I know that this isn't exactly what I should be learning, but it also is. This is the very fundamentals of fundamentals. So learning the reasons why a stronger dollar can be bad for an index and why it can be good is important to know, I guess, to point out to myself when reading the papers or the news or the documents, how it will affect the US dollar, therefore how it will affect the indexes. Okay. Why a stronger dollar might not always be bad for it. Okay. Inflation control. If the dollar is strengthening due to tighter monetary policy, example, the Federal Reserve raising interest rates, it could be a sign that inflation is being controlled, which might boost investor confidence and potentially benefit stocks in the long term. This is in the long term. This is in the long term. I'm an intraday trader. US economic health. A strong dollar often reflects a strong US economy, which can be good for domestic companies, particularly those with substantial business in the US. A strong economy can offset some of the negative impacts of a stronger dollar on international sales. Investor confidence. A stronger dollar can be a sign of stability and confidence in the US financial system, especially in times of global uncertainty. This could lead to inflows into US assets, including stocks. Okay. I'm just going to do investor confidence. Why a weaker dollar might be good for stock indexes. Boost to exports. A weaker dollar makes US exports cheaper and more competitive internationally, which can boost the earnings of export-driven companies. Higher corporate profits. Companies that operate globally may see increased profitability when their foreign revenues are converted into US dollar at favorable exchange rates. Inflation and interest rates. A weaker dollar can signal inflationary pressures, which might lead to looser monetary policies such as lower interest rates that could provide a boost to stocks by making borrowing cheaper and stimulating investment. Okay, this all makes so much sense. Okay.
If a bank offers you 2% in another country and then it offers you 0% or even negative in another country, you'd probably rather, if you had to stick your money somewhere, you'd probably rather put it in the place that offers higher rates, so long as the economy is stable underlying where your money is. So that's the first one, interest rates. Now, we can look at an example here. You can see here's Canada's interest rate. Now, we shouldn't pick on Canada too much because all interest rates around the world right now, for the most part, many countries have cut rates dramatically to sort of cope with or deal with the 2020 pandemic that we faced. Now, cutting rates is a way to sort of stimulate economies, and it is usually seen as sort of a concerning thing for a currency, because if you have to cut rates, it means that, the economy underlying could be in trouble and they need to cut rates. And it also makes, again, going back to that, where would you stick your money? If there's less currency or less interest being offered in a certain country, you may be less interested in, parking your money there, if that makes sense. So, for the big players that have billions and trillions of dollars, big institutions and companies and, big people groups that want to put money somewhere, if there's less interest offered in, say, Canada, maybe they're less interested in parking their money there, and maybe they'd rather park it somewhere else. Just a simple concept. Now, the next one is going to be inflation rates. Now, inflation, this gets tricky really quick, so I'm going to do my best to explain this, but if you need to rewatch this, you can just back up in the video. But inflation is the rate at which the value of a currency is falling, and consequently, the general level of prices for goods and services is rising. Okay, inflation. There's actually a healthy level of inflation. People always view inflation as bad because locally it is perceived bad, because if your currency is losing value, right, they're printing more of it, or the value of your single US dollar or your Canadian dollar, wherever you are in the world, right, if that's losing value, it seems bad. However, there is a healthy level of inflation that comes along with a healthy growing economy.
Sentiment, bullish, bearish, neutral, yes. This report shows how many jobs were created in the economy excluding agriculture. A strong NFP report is often seen as a positive sign for the economy and can boost market sentiment. If the numbers are weaker than expected, it can be seen as bearish. Now, okay, for stocks, okay, we're going to keep this in mind. Bullish, which means strong job growth. Okay. Which is positive for the economy and for stocks, which obviously is positive for indexes. Bearish, weak job growth, negative for consumer spending and economic activity. Okay, I need to see how NFP affects all these affects the dollar as well, so I can really understand what's going on now. CPI, these are inflation indicators. High inflation could lead to the Fed to raise interest rates, which is usually negative for stocks. Right, okay. How to read news data. Okay. NFP. Okay. NFP. Bullish. Strong job growth. Sorry, my microphone's way out the way. Strong job growth can be seen as positive for the economy and stocks. Bearish. Weak job growth can be seen as negative for where am I? Consumer spending and economic activity. Okay. Consumer Price Index, CPI, and Producer Price Index, PPI. CPI and PPI. Okay. CPI and PPI. bullish, moderate inflation, or inflation below expectations, positive sentiment. Inflation below expectations leads to a positive sentiment. High inflation. Could trigger high inflation could trigger higher interest rates. Negative for stocks. Okay, so why is it negative for stocks? Because higher interest rates make it more expensive for companies to borrow money, which can slow down growth and affect profits. Also, many companies within the US 500 earn significant portions of their profits from overseas investors / consumers. A stronger US dollar makes goods and services more expensive for foreign buyers. That is why CPI and PPI can be bearish if it has high inflation, and the opposite if it has inflation below expectancy or moderate inflation. How to read news data. Again, okay, we have GDP growth. So, a strong GDP report indicates that the economy is expanding, which is good for stocks. GDP growth. Do I even look at this? Let me check the history on Forex Factory real quick. Prelim GDP. Okay. We've had this before. Actual forecast previous 2.3%. Got it. What is today? 13th? Yes. So we have PPI today. Perfect. So we can implement this. 8:30. We can implement this. GDP. I'm just gonna write prelim GDP. I'll just do GDP. GDP. Bullish. Okay. Strong GDP growth is positive for stocks. And then obviously bearish. Low or negative GDP growth is negative for stocks. Okay, Federal Reserve announcements. Jeez, we got quite a few. Okay, interest rate hikes or cuts. The Fed's decision directly affect market liquidity. Rate hikes generally signal the Fed's concern about inflation, which can hurt stocks due to higher borrowing costs, rate blah, blah, blah. So, Federal Reserve announcements. Is this when like Powell speaks and stuff? Okay. Fed Reserve announcements. Oh yeah, we've got this next week. We've got federal funds rate, FOMC, which is all at 2 p.m. Usually these are outside of the times I trade, but that's okay. We'll still write it down because it's good to know. Okay. Bum bum. Bullish. Rate cuts or dovish comments, which is Fed. Okay, or dovish comments. That's okay. I gotta learn what they are, which is alright. Markets like cheaper borrowing costs. And shows buys are in a discount. Bearish. Rate hikes or hawkish comments. Okay, rate hikes. I'm learning the terminology. Yeah. Okay, rate hikes or hawkish comments are negative and show buyers are in a premium. FOMC statements and minutes. The Fed statements and meeting minutes can give insights into future policy. Hawkish language talking about higher rates can be blah, blah, blah. Okay, so this is the same thing. This is with the FOMC. So let me Fed Reserve announcements slash FOMC. On projections of state statement. Okay, corporate earnings. Earnings report of major companies. Okay, so let's. How to read news data. Okay. Earnings reports from major companies. Tesla can move indices significantly. Okay. Significantly, right. Bullish. Strong earnings and guidance. Okay. Strong earnings increase confidence in the market, particularly in tech heavy Nasdaq and large cap stocks in Strong earnings increase confidence. Okay, bearish. Weak earnings or poor future guidance. Okay, weak earnings. Future guidance can drag down indexes. Especially in tech stocks. NASDAQ. Geopolitical events. Trade policies or wars. Okay. Trade tensions or the potential for military conflicts. Positive trade deals. Trade tensions. Bearish. Okay, so look, if I knew this, the whole trade tensions thing and military conflicts, even just military conflicts aside, but these are actually both happening at the, like, as we speak, the trade tensions and military conflicts. The entire conversation with JD Vance, Trump, and Zelensky, military conflicts, they are no longer funding Ukraine. Ukraine's trying to go to the UK to get money. They're going to lose to Russia anyway. Escalating trade tensions with the US announcing high tariffs between, what is it, Mexico and Canada? These were negative, bearish. And if you look at the market, which we can see right here, in the past 3 weeks, we'll do the 4-hour chart. In the past 3 weeks, we have done nothing but shit the bed. And look at this, February 21st. Let's have a look. Oh, I am, oh, my, okay. Spelled that wrong. Global trade war. Yeah, there's a trade war going on right now. Okay, I'm not sure on the exact date, but this whole move down is pretty much from the trade war, which is just tensions. It's just tensions in the market, and look how that reflects even on the daily chart. Look on the daily chart, man. We haven't seen a move down like this in a long time. I mean, very similar to August last year. Very similar to August last year. I mean, a move down like that hasn't happened. So yeah. And it is potentially still going down. Let's get back to track. Okay. So, geopolitical events. Trade wars, trade policies or wars. Okay. Slash trade policies or wars. Bullish. Positive trade deals, which is security in the economy. Positive trade deals. Yeah, boosts confidence in economy. Bearish. Escalating trade tensions or military conflicts. Okay. Or military conflicts. Conflicts. I've misspelled that badly. Increases. Okay, I'm just gonna write negative for stocks. How to analyze the sentiment. This is huge right here. Before the news, look at pre-market futures for the S&P 500 and Nasdaq. Futures indicate how investors are positioning themselves ahead of important data. If futures are up, it typically means positive sentiment. If they are down, it could indicate the opposite. This is exactly why we use high time frame to determine bias, and I didn't even know this. I'm just learning this now. Even daily. Let's look at the daily. We can see, okay, before news. We'll go because it's intraday trading. Before news. This is also a daily fair value gap, but these 4 hour fair value gaps, this one, this one, this one. We've reached in, we're selling. People are bearish. Before news, we reached in, same thing, we're selling. We broke 1 hour structure. We actually broke it here. Oh. But I mean, once again, just shooting past lows, coming up to feel equilibrium or an imbalance, as you know market likes to do. Equilibrium, exactly. And I mean, we got 30 minutes on this candle, may not even break structure. We can go deeper into the 15 minutes broken structure to the upside, 5 minute, okay, so and so. That is why we use high time frame as our bias, so we can see the sentiment. We can see the sentiment is bearish as fuck. Right, I'm learning. Okay. How to analyze sentiment. So sorry, this is how much it makes sense. It is genuinely this simple. If you analyze before news data comes out, what everyone's doing, where they're positioning themselves, they're all shorting here. Everyone's shorting except for, here. But this could be people trying to get into a discount. Everyone's shorting here. They have a negative sentiment. And then obviously they've got key price ranges where they want to close some of their positions out. That's just take profits. Anyway, for entries, the market is bearish. The hedge funds are bearish. The banks are bearish. The retail traders are bearish. News comes out bullish. Confusion in the market. Don't trade. News comes out bearish, supporting yours and majority of the traders' bias. You go down to your lower time frames, see what you need to see, find your entry, and follow the trend. Follow the trend of the market sentiment and the news sentiment. I'm understanding now. Okay, let's write this down. Before news, look at pre-market futures, blah, blah, blah. Analyze pre-market sentiment. If it's not clear, don't trade. Analyze pre-market sentiment. See where investors are positioning themselves ahead of important data. If futures are up, it typically means positive. If they're down, it could indicate the opposite. Okay, we know this. We don't have to write that down. During the news release, watch for the actual versus expected data. Okay, I gotta write this out differently. During news release, watch the actual versus expected data. For example, if the CPI comes in higher than expected, you might see a strong negative reaction in the stocks, especially growth stocks like those in the Nasdaq. As investors anticipate higher interest rates. Okay, we can just leave that there because we know what to do with actual versus expected because we've got it all here and the previous pages. Okay, after the news, post news release. Monitor how the market reacts post-release. Sometimes the initial reaction is an overreaction and the market may correct itself. Keep an eye on the broader market trend and whether it matches the sentiment from the news release. Okay. Monitor how the market reacts to the data. Sometimes market over reacts and needs to correct itself. Keep an eye on broader sentiment. And whether it matches news data sentiment. Okay, look for consensus. Often you can get a clearer picture by comparing different news sources. If most reports indicate that the news is bullish or bearish, it is likely to be an accurate reflection of market sentiment. Use sentiment indicators and tools. Volatility index, known as the fear gauge, the VIX, can show market sentiment about potential market turbulence. Rising VIX typically signals fear and uncertainty, often in response to negative news. Market breadth indicators. These show the number of stocks advancing versus declining. If most stocks in the S&P are rising, it's generally positive sentiment. Breadth this week may indicate more cautious or bearish mood. Okay. S&P is more diverse, including sectors like energy, healthcare, financials, and consumer goods. A broad set of economic data and corporate earnings can influence the S&P. It reacts to economic growth inflation, and corporate earnings. More tech-heavy and growth-orientated, which is the Nasdaq, is more sensitive to interest rates and inflation. Higher rates hurt tech stocks more, so news about rate hikes or inflation will have a more significant impact on the Nasdaq. I did not know this, guys. I did not know any of this. Let me write this down. Okay. ES versus NQ sensitivity. ES. More diversified. Reacts to economic growth, inflation, and corporate earnings. Corporate is the perfect word for corporate. Nasdaq, NQ. Reacts to interest rates and inflation. Okay. Conclusion. To understand market sentiment in the S&P and Nasdaq using red folder news, pay attention to key economic reports like jobs data, inflation reports, and GDP growth. Watch for Federal Reserve actions and blah, blah, and I'm not going to say blah, blah, blah. Actions and statements regarding interest rates. Analyze corporate earnings, especially from large companies within these indexes. Track the market reaction via futures, news sentiment, and volatility indices. Okay, guys. This is ridiculously helpful. What the fuck? There's a massive amount of context behind all this shit now. I have to go over these, I have to go over these notes. Maybe even backtest. I might go look at previous news data and backtest it to see how these indexes react to the news and what indicates clear sentiment versus mixed sentiment and consolidation. Thank you for watching, guys. If you